Okay, thank you very much for joining us today. This is an economic update as of today, July 14th, 2016. My name is Kenneth Hunter. The information that you're going to see is information that I have gathered on my own and does not reflect the opinions of anyone that I professionally work for and anyone I'm professionally associated with. They are my own personal opinions and analysis. And we'll go ahead and get started with a quick overview of some of the topics that we'll be covering. Really discuss current measures. When we get into discussion of stocks, spend a little time on political impacts, particularly with respect to the upcoming elections and what happened very recently with the Brexit vote, Britain choosing to leave the European Union, and then just talk a little bit about the months ahead. There will be another presentation I'll be doing next month that will have a little more on that last item, but there's a lot of good information here for you with respect to some charts and other information. This is a chart deck, and the PowerPoint will be available as well at the link that this is available at here in the near future. So to begin, first slide we want to look at is look really where we are in terms of where economic indicators are going. And you can see here that overall indicators are looking positive, but there is the potential for some slowing. Leading economic indicators have been strong. The index of 100, which was set that index was set around 2010 towards the end of the recession. A score of 100 would mean that, things are stable. But, the fact that we're at 125 right now is a good sign, but as you can see, it's kind of beginning to taper off a little bit. The coincident economic index, which is more about what is going on at the present, the LEI is the expectations in the next 3 to 6 months. And of course, the comment to the right, the LEI suggests the economy will continue growing at a moderate pace. There is hope that it will continue to grow at a moderate pace. However, there is a lot of uncertainty out there, and the uncertainty is being driven by what's happening with elections. It's being driven by some concerns about the markets, even though as we'll look at with the markets are doing well. And, just some general uncertainties in today's world. We do run in kind of a hyperactive pace, and there's just not a lot of people don't feel as secure as they used to. And I do think it has an effect. And as you can see, towards the end, it said moderating outlook in labor markets, and we'll talk a little bit about that in terms of where the labor markets are heading, because there may start now being some real pressure on labor cost. Depending on where you are located, you may be seeing this directly, and other places may not. But there's of course, we do want to see people earn more, and at the same time, as labor costs go up, that does start affecting the cost for goods and services, and that can have a kind of a downward pressure on the economy overall. The Federal Reserve 8 times a year publishes a kind of a survey document. It's a narrative survey document of economic activities and outlook called the Beige Book, and they do a national. It's in different sections. The first section is kind of the national section, and it looks at the national economy as a whole for the United States, and then they do a separate summary report for each of the Federal Reserve districts. And so mainly what I want to focus on is the overall national, some passages from the national summary from the Beige Book that was released yesterday, and this would be basically for the period of mid-May through June, as that first item indicates, and it also just briefly highlights some notes from their review of the Mid-Atlantic, or the area that is served by the Richmond District of the Federal Reserve, which includes Virginia, the Carolinas, and Maryland, as well as the district. And the first item, as you can see, is they are anticipating nationally to continue to see a modest pace of growth here in the early summer, which would indicate that more than likely when we see the second quarter gross domestic product, or GDP numbers, at the end of July, that we should see some uptick. Now, we have seen where the Federal Reserve economists, those who serve on the Federal Reserve Board, have kind of downgraded their look at where economic growth is going to be, and are now looking anywhere from between 1.5 to 2% for the year in terms of real economic growth for the nation. And we'll just have to see if that remains consistent, but that could be the case. Again, we had a kind of weak first quarter of the year. We didn't see a lot of growth during the first quarter, so that does have an effect in terms of overall growth going into the second quarter. As you can see here, they do like how the labor market is going. It has been stable. There's been continued growth in employment. Really, there has not been a lot of pressures created by cost. We'll see a little bit of that when we look at the consumer price index. They're seeing some positive activity with consumer spending. At the same time, they're seeing it soften a little bit. And we'll talk a little bit about consumer confidence towards the end. And with respect to manufacturing activity, and we'll cover this here pretty quickly, it's mixed, but there is some general improvement with respect to manufacturing activity nationwide. Probably the sector that has been the most consistent nationwide right now is real estate, continuing to strengthen both with residential and commercial real estate. And banks are in a position, in part because of customer balance sheets and desire for real estate and other factors, are increasing to respond to increased loan demand. Agricultural activity appears to be improving, though it's mixed, and a lot of that, of course, is dependent upon the region in terms of weather and other factors. And, of course, the thing that we have noticed, and this is a lot driven by how we've seen the decline in oil prices and natural gas prices and other resources and commodities in the last 2 years, we're still seeing weakness in that sector. But they do overall at a national level expect positive growth and expect it to remain positive, though in a modest fashion. And this has kind of been, this is, I think, the statement, expect growth to be modest. That's, I think, what really frustrates people, because as much as we talk about the new normal, as much as we talk about economic growth kind of being at this post 2008 recession level of around 2% annually a year, it really just frustrates people. And I think a lot of that also has to do with that while the national economy may only be growing by 2%, there's greater disparity from a geographic perspective. We can sit here and talk about, the 1% versus the 99%. But what the real aspect is looking at it from the perspective of those who live in areas where the growth is higher or much higher rate than the national average to those areas where it's lower or where they're still dealing with negative economic activity in real terms once you adjust for inflation and other factors. And I think that those disparities are creating a lot more of a challenge overall. Nationally, can we sustain who we are with an annual growth rate of 2%? I'm not for sure, but obviously there's a greater range or deviation. There's a greater range or standard, what they call standard deviation, but a range of differences compared to how different local places across the country are acting with respect to the economy. And when you look at the Mid-Atlantic, what you see is that they do anticipate modest overall growth, and have seen that for the spring as we go into the late spring and early summer of 2016. Seeing improvement in various sectors, including tourism, consumer loan activity, residence commercial real estate, and also seeing growth in labor demand. This continues. Of course, you've got Virginia with Richmond and the D.C. area, North Carolina, you've got Raleigh, Durham, Charlotte, Asheville, Wilmington, Maryland. You have some activity up in Baltimore. You've got some activity in Delaware. They also, however, are seeing some soft activity, and that's they're seeing some softening in the market with respect to manufacturing. There have been some slight downturns, and we'll show some charts here in a second with respect to the manufacturing sector. Retail sales have also softened some, and I think retail sales is just going to be one of those areas where we're going to continue to go through this kind of creative destruction or this transformative destruction of the retail sector, where it's going to change dramatically over the next couple of years, and that is going to have an effect. The retail activity may stay the same, but it will be less localized from the standpoint of most things that people buy as online sales and other forms of direct sale activity increase. Raw material prices. Some raw materials have gone up, including wood and steel, which has, of course, affected finished good prices, but finished good prices are also affected by labor costs, which have also gone up, particularly for skilled trades, due to the high demand and low supply of skilled tradesmen in various parts of the country, and it is having an effect on retail prices. And I think also retail prices are being driven by the desire of companies out there to try to restore their profit margins. But one thing that is good, even though manufacturing activity has declined a little bit, is manufacturing employment remains stable. So companies are not yet in a position, for the most part, to be engaging in layoffs. Though in certain markets, I've seen it some information coming out of the Raleigh area. There have been a couple of companies, including service companies and manufacturing companies, who have engaged in some layoffs, but in some cases those may be not as much of their local manufacturing demands or demands of their particular facilities, but more part of global restructuring. Looking a little more at where the various industries are headed, the ISM composite indexes for manufacturing and non-manufacturing. If you go to look at the left, the manufacturing index, 50 is kind of the mean point, so you want that number to be above 50. And as you can see, in June it did kick up a little bit, which is a good sign. But the overall most recent moving average as of June is right at about 50, and you can see a lot of that had to do with a decline that we saw in the second half of last year. But it has started to pick back up, and that hopefully will indicate that we're going to see some improvement in the sector within the rest of this year. But as of right now, it's still kind of in a soft position. A lot of that seems to be driven by export orders. Our manufacturing sector does do a tremendous amount of export activity, and that, as you can see, at the same time that overall manufacturing saw a decline, the composite saw a decline. A lot of it kind of looks like it's directly correlated to export activity. Some of that is because the U.S. dollar has strengthened as some other currencies around the world have weakened in the last year, and so there has been some challenges in the export industry. We're still doing very well with respect to exports, but there has been some tightening in that area. Meanwhile, the non-manufacturing, the service sectors continue to remain strong. Slight downturn in terms of that moving average, but as you can see, overall it still remains in a positive growth territory and has remained that way since the recession ended. Looking at the Mid-Atlantic region, this information is from the Richmond Federal Reserve. You can see that those two lines there, the dark blue being the moving average and the light blue being the month-to-month mark. You can see that the month-to-month mark did return into negative territory in June, and again, a lot of that was tied to orders. So there was some contracting in order activity according to the Richmond Fed report on this, their survey. There was some contraction in order activity, and that is something that will have to be watched for. Hopefully that this is just for a brief period of time. Hopefully it's just a month-to-month issue, and that we'll see order activity pick up. But again, it is something that has to be watched pretty carefully, because if there's a gradual or consistent decline in order activity, that could signal some issues in the manufacturing sector, particularly with respect to employment. Looking at the Carolinas, for those of you who are in North and South Carolina, like myself, here in Eastern North Carolina, looking at this, again, a positive score is a good thing, even though we don't want to see downward trends. We want to see the trends go upward. But as you can see, current activity, late spring saw improvement, but then as we kind of come into summer, that number went down slightly, but it still remains. Overall sentiment of business activity, this is more in the services sector, does seem to be positive, and even though it has declined a little bit, there is some positive feelings about the remainder of this year. As you can see, again, those numbers are above zero, which is where they need to be, and those are not the best trend that we can see, but we're still in a positive light, and hopefully those trends will improve in the second half of 2016. Now, thinking about what could be affecting matters. Well, first of all, there's inflation, and the chart that you see here, because of the way that these charts are prepared, these charts are prepared using some software that's available online through the St. Louis Federal Reserve, and so they changed it this year to be more wide carriage. In the last couple of months, they've changed it so that it's more a wide format. It's not a square format, because of course most of you now use wide screens and 16:9 and HD, so they look a little different, so it kind of distorts the view compared to what you may have seen in the past. But the key thing to understand is, this goes back all the way to 2010, and what you realize is that in the last 3 years, we've had inflation going up at about an annual rate of around 1%. Now, this is total inflation, which includes fuel or energy cost and food cost. So overall, that inflation has gone up based on what the CPI says, has gone up only about 1% each year for the last 3 years. Now, this is at a national level, and of course, inflation can be different depending on what the products and services you need to use are. For example, if you're more dependent upon medical services, or you're more dependent, or the cost of living with respect to real estate is higher in your market, it could affect how inflation affects you locally. But at a national rate, we've only seen it gone up about 1% per year over the last 3 years. When we do, however, remove food and energy, which there is some volatility there, particularly with what we've seen with energy. We take those out of the equation and we do what's called core inflation. You would see that what's good is that that's only gone up by about 2%. If we saw a significant disparity between where core inflation and total inflation were, like if, for example, based on the idea of total inflation being 1%, and we saw that this core inflation was like 4 or 5%, that would be a concern. But in general, over the last 3 years, it's remained around 2% with total inflation at 1%. That's close enough. There's not a huge disparity between the two of them. Now, with respect to the cost for producers, for those of you who are manufacturers who are producing products or who have to purchase from manufacturers directly, with respect to those in retail businesses, you can see that there has started to be a rebound in producer prices. As we were kind of going towards the end of 2015, we saw that those prices were dropping, and a lot of that, of course, was being driven by the reduction in energy costs and some other commodity costs. Part of that was due, of course, to increased supply of energy from other parts of the world, and some of it also was due to slowdowns in other parts of the global economy, including places like China and Europe and other parts of Asia. But what we have seen is that since February, when it reached the trough that you see there, we've actually seen producer prices, and this is as of this month, as of the June report, which came out earlier today, have gone up about 3.4% in that period. Still, when you look at where we were compared to a year ago, we're still almost 4% below in the producer price index. Now, of course, this is tied to all commodities. Each company uses commodities in different ways. There's a lot more data. You could spend a whole hour just looking at producer prices, but as you can see, overall the trend is good. And even if we do see some recovery, that's not necessarily a bad thing, though I realize for producers trying to maintain product costs in terms of cost of materials is important, particularly if they're facing issues with rising labor cost. This all, of course, then ties back to the market. And where's the market going? Well, the best way probably for us to kind of take a snapshot look at the overall market is to look at the Standard & Poor's 500, and that's what we've done here. These charts are prepared by a really good blog that's out there, Global Macro Monitor, and they do these, typically did these as of June 30th, which is nice because they were done basically a week after the Brexit vote. The Brexit vote occurred on June 23rd, and so they're kind of able to give you an idea of really where we are year to date. And as you can see, following kind of a slow beginning to 2016 in the first quarter, you can see overall that the Standard & Poor 500 increased by almost 2% in the second quarter and is up about 2.75% for the year. You can see that that there are various sectors that have done very well. Including that in the second quarter it was really driven by energy. We did see oil prices did improve some, and there were some other signs that the energy market is improving some, or that it's now kind of in a stable position. Healthcare stocks improved. Others tied to retail, like consumer staples, improved. Financial stocks improved some. Financial stocks needed to improve because, as you can see, when you look at year to date, financials have seen the sharpest drop of more than 4%. But we've also seen, and you can tell, really, utilities has had the highest growth over the course of the year, along with energy. Retail's done very well in terms of consumer items and materials. Industrials have done well. But overall, as you can see, most of the sectors of the economy have, in terms of most of the sectors in the stock market, have seen growth in some manner or form throughout the course of 2016, which is a very good thing. Going now to look at the item that has been on a lot of people's mind and has been talked about a lot in the news, and that is the Brexit effect. And just to kind of give the short version, on June 23rd, there was a vote in England. In Great Britain. I always kind of mess that up. But there was a vote in Great Britain for the people of Britain to decide whether they wanted to remain with the European Union. This kind of was to kind of brought about the end of an experiment that had been in one shape, matter, or form since the end of the Second World War. It had started as the common market, which was more about trying to create a unified zone amongst European nations with respect to trade, and then by the late 80s, early 90s, evolved into the European Union, which actually was kind of a bureaucratic like a continental government, which actually did have some role in actually regulating the lives of individuals regardless of the country, and of course created a matter allowing for open borders between each country in terms of freedom of movement. And a couple of other factors, and the people of England were bothered. The people of Great Britain were bothered by it. Some of it due to economic concerns, some of it due to concerns over immigration. Prime Minister David Cameron, who was Prime Minister up until early yesterday, decided, based on sensing the will of the people, even though he was opposed to it, decided to hold a public referendum on whether or not Britain should leave the European Union. As now, most people who were in the investment in the financial sector were hoping that the Brexit would not occur. They were hoping that Britain would remain part of the European Union. And when the polling kind of came out on the early in the day of June 23rd, there was an indication that the Brexit vote would fail, that the majority of Britons would actually vote to remain in the European Union, and that led to a little bit of a growth on that day. Actually, the S&P performed very well for June 23rd. But as you can see, over the next couple of days, that was a Thursday, and the subsequent Friday and Monday, after it was learned that the vote did pass and that the people of Britain decided they do want to leave the European Union, it did lead to a significant drop. And for the S&P, which is the American, which reflects American stocks, that drop was more than 5%, just a little more than 5% within the course of 2 trading days. 27th was a Monday. However, even though that there had been some people who had bet on the vote not passing late in, the overall effect was relatively minimal because that sharp 5% drop turned around quickly into gains within a very short period of time, basically to the point where by the end of the week on Thursday, June 20th, when I showed you the chart from before, we actually saw that they had almost pretty much erased all of the losses that had been suffered since June 23rd. So within a 1 week period of time, we had seen this S&P go down 5% and go back up 5%. And then as you can see, if you look towards the end of that chart on July 13th, you will note that they are now at 2152, which is a new record for the S&P. The Dow is at a new record right now, or it was as of yesterday. It may be down a little bit. I haven't checked it today. But overall, that's an indication that this political decision, which does have some impact. I mean, it's not a benign event, but from the standpoint of the overall American economy, it's not expected to have much of an impact. I was listening to a webinar that was done Tuesday by some people at Wells Fargo, and they basically said that overall there's just not enough economic activity that America is tied to with respect to import-export activity that necessitates a concern for the United States, nor is there really for Canada. Again, our primary trading partners, despite all the stuff that we do with Europe, all the stuff we do with China, our primary trading partners remain Canada and Mexico, and our relations with them are very good. There is, some scuttlebutt that if things do not go well in the election, that there may be some, well, I shouldn't say that. There's some scuttlebutt that if a certain candidate wins the presidency, that there could be some issues in terms of our trading relationship with Mexico. But to me, I look at that, even in that case, being more of some issues in the margins and not affecting the overall trade relationship. But if something like that were to happen, it does have the potential to have a negative economic impact for us, at least in the short term. Going now to looking at some of our commodities with respect to oil. When you look at the activity since May, you can kind of see that we finally reached, I think, a point of stability. And that's not to say that the price is the same every day, but I would say, 2 years ago, there was kind of like this range on oil prices where the price for a barrel of crude oil was between $90 and $110. It just seemed that it kind of, for 2 years or so, it kind of remained in that range. Then we had this huge drop off back early last year, or kind of started late 2014, went through all the way through 2015, and even continued into 2016, where you see that the price got below $35 a barrel in mid-February. And since then, it's kind of picked back up, and I think now we're kind of in this zone where we can expect maybe prices to be basically between probably 40 and 50, 40 and $55 a barrel. And that's a good thing. That's a fair price. The concern, of course, is what's driving it. In terms of, is it being driven by production or is it being driven by a reduction in demand? It's kind of a combination of both. Is there a possibility that we could see what would happen if we saw the Middle East start pulling back on their production in their efforts to try to corner the market some and try to take some of that production away from the United States? That could see the price go up. Some of you've probably heard, some of the resources we have for oil, including shale and some of the other methods, it does require the price to be higher in order to justify the cost of the production. But right now, this range is pretty good because it's keeping gasoline prices at a reasonable rate. Here's the chart from GasBuddy that kind of reflects that, and you can see that there's kind of a correlation between the two. The blue line is connected to the prices on the axis to the right, and you can see that as of right now, compared to where we were about a year ago, the price for the national average price for unleaded gasoline is down by probably around 55 to 60 cents a gallon. And that's a big deal, particularly in the summer months. You see that it did go up in the spring, in the early to late spring, and a lot of that's because in many places there's the reformulation of fuels, which does affect the available supply with respect to demand and does lead to some cost. You can also see that crude prices did go up some, so that affected it as well. But you can tell that overall, if prices for oil, prices for gasoline are down considerably to where a fill up, the price per fill up could be dropped by as much as $10 to $12 per fill up. That could be a big deal to a family. That could affect them by maybe $100, if not more than $100 a month in particular, and also businesses several hundred, maybe several $1,000s a month in terms of their cost. Certainly some savings that they would appreciate right now. Going to the next slide. Looking with respect to mortgage rates, this has also been a good thing for people who are looking to buy a home or refinance. Throughout this current calendar year, starting in January, mortgage rates have remained below 4% on the 30-year conventional mortgage. That's a good sign in terms of, for that. Well, I wouldn't say that's a good sign. It's more of a positive for people who are trying to look at buying a home or looking at refinancing their home to have rates at that low. As you can see, it's been a long time since we've been at that point. It was about it was more back during the post-recovery period that we were kind of at that point. It has, of course, helped to accelerate the housing market some, and it's helped to increase housing activity. But if you were to look at it compared to where we were back in 2008, the activity is still more subdued, both in terms of activity, in terms of actual buying and selling, as well as with respect to construction and other factors. Now going over into the employment area, we do see that employment does climb overall. We have seen employments climb up. We're now the latest. The red line is the line that's not seasonally adjusted, so it actually reflects actual employment activity. And as you can see, it reached 152 million in June, which is a good sign, and that continues to go up. It's about now 6 million ahead of 5 to 6 million ahead of where we were in late 2007, early 2008, right before the recessionary period, and it is of course now more than around 14 million more than where we were at our recession period low or post-recession low that we've tried to climb out of over the last 8 years. However, at the same time, looking at some of the things that have factored to this, we have to understand that the labor market is still in recovery. This chart goes all the way back to 1990 and shows the employment to population ratio, the percentage of individuals between the ages of 25 and 54 who are employed. And this is important because this is kind of your key employment range. This is not, a large portion of your available workforce, and it's kind of the prime employment years, this 30-year period between 25 and 54. As you can see, in 2000, it was at its peak at about 82%. Now we know that there started to be, some pushes in retirement, but it really shouldn't have affected this group as much. But we can see that in the 2000s, following the brief recession we had in late 2000 to 2001, and then until the 2008 recession, it did rebound, but it was only got up to about 80%. Now, despite going all the way down to 75% during the recession, it has only recovered up to 78%, 77.5%, 78%, and that's an indication that there is a sizable percentage of the overall population that's simply not in the labor force. That helps keep unemployment rates low, but it does reflect kind of a loss of a resource. And the question being is, do we have enough people working to be able to afford everything from a family? Can families, if they had been two-income families, can they afford to be a one-income family, or can they afford for where one person has a part-time job, whereas opposed to in the past both of them may have had full-time jobs? And then, of course, on a larger perspective, can our economy and can our government afford the entitlements of a smaller percentage of the overall workforce is actually of the actual overall population is actually working and contributing through their taxes? This is some information with respect to hiring and openings, and as you can see, the hiring and opening activity is improving. They remain at strong levels. There's a lot of hiring going on, and there are also, of course, a lot of openings. It remains a challenge for a lot of employers in order to try to find people to fill positions. They are also starting to see an increase in resignations. This is something which likely means that there will be a corresponding increase in wages in order to offset this, to encourage people to stay in work and not jump to other jobs. But the reality is that and of course, that also does impact labor costs that are not necessarily under as much control by employers as they try to get the right talent to meet their needs. And of course, those pressures can result in some inflation in finished goods or have some other potential economic impacts. If you look at unemployment, and kind of getting back to what I said before, you can see that line at the green is the civilian unemployment rate, and as you can see, it has fallen now back down below 5%, kind of back where it was prior to the 2008 recession. However, if you look at the lines above it, the blue line, the red line, these are some alternate measures that are done out of the Richmond Federal Reserve. And what they look at is they look at the people who are just simply not employed, not unemployed, but not employed. And if you notice this, that red line shows that the percentage of people who are not employed looks to be around 8.5%, and it was around 8% prior to the recession. But then you look at the ones for those who are not employed or who are working part-time because they simply cannot find a full-time job. In other words, they're forced to work part-time. You can see that level was in the neighborhood of 9% prior to the recession, and is now at around 9.5%. I will say that those are probably more accurate. Regardless of the measure, you can see that we're not where we were in the pre-recession period. We're getting there, and again, these are national numbers. Just like we've seen with other things, there is likely greater disparity in these measures of employment and unemployment from locality to locality or metro area to metro area as a result of a lot of the changes that have occurred at a local level throughout America since the start of the recession in 2008. To look at North Carolina, just to kind of give you an example, here is our change of employment as of the last measures we had of statewide data, which was May of this year. And as you can see, so far for the calendar year, overall employment in North Carolina has gone up about 2.6%, and metro areas is actually a little behind the pace at 2.4%. If you were to compare it to May of 2015, statewide employment is up 2.5%, metro employment up 3.2%. But if you were to look at where we are since January of 2008, overall the state has grown actually 8.5%. So we're actually 8.5% ahead of where we were in terms of total employment since since January of 2008. So we're significantly ahead of where we were in terms of total jobs. But when you look at but then you look at metro areas. Metro areas are ahead by 12%. The Raleigh area is ahead by more than 22% during that period of time. I mean, you think about it, that their total employment has grown by nearly 25% since the high levels they experienced before the recession. That's a huge increase in employment, and it's contributing to the economic success that they are having in the Raleigh area. Significant economic success at this point. So, kind of getting back now to the consumer and their opinions. Consumer confidence is improving a little bit. It has improved recently. We're back at around 98. 100 is kind of the benchmark number that we want to be at to indicate that consumers are are heading into a range of confidence and are not pessimistic. You can see that year to year, it's about 2% down compared to where it was a year ago, and we're hoping that maybe that's an indication that it's going to get back up. But as you can see, while consumer confidence has improved since it reached significant lows during the recession, at the same time, it has a long way to go. It still has a ways to go before it can get up in positive territory. And again, that's just a reflection of the public being weary and being, of course, being concerned. There's a lot of volatility going on. Part of it, of course, being simply just a lot more information that is shared, and so there's so much more that people can learn about the economy. And of course, sometimes information makes you worry more, but there is a lot of potential for the public with respect to moving forward. And now looking at, so if consumers are confident, is what could be driving this confidence going forward. And there's two things that can affect how much someone can spend. One being how much they earn, and then also how much their ability to take on additional debt. And what we see is right now is that about 17% of those surveyed expect to see their income increase over the next 6 months, compared to only 12% that see it to decrease. That's a good sign. That the fact that we continue to be in a direction where those who expect an increase is greater than those who expect a decrease is a good sign. And then you look at the credit, you can see that there has been a growth in terms of revolving credit and non-revolving credit, but it's at a modest level. It's not at those levels that we saw back in the 90s and such, and it seems to, and hopefully it'll remain stable. There can be some growth in credit. It just needs to be a growth that's consistent with wages and consistent with overall growth in wealth. If it gets too much out of whack, then it could result in a significant drop later, which of course can have a significant impact on the consumer-oriented segments of the economy. Also, just wanted to take the opportunity as we kind of come towards the end of this session, looking at debt as a whole. As you can see here, there's several different types of debt. Overall, when you look at the role of mortgages and revolving credit, those two sources of debt have kind of remained at a level lower than where they were during the recession, and a lot of families have done their best to deleverage or to reduce those balances. There's been some other factors as well that have contributed. So the growth, there has been, of course, some growth in debt, and there will be some continued growth in availability of debt. But it's really been tied to two other sectors, and one has been automotive. Auto loans have grown, particularly since 2013. A lot of people are out buying cars. There was a pent-up demand issue resulting from the recession that needed to be addressed. But as you can see, the sector that has just continued to grow and grow and grow, grew during the recession and continues to grow at a very significant rate, are student loans. Student loan debt continues to grow, and as you can see, it's up to now to an index of 281. Is basically that indicates that it's grown by a magnitude of 3 in just the last 10 years. That's a pretty substantial. And of course, that is becoming a bigger and bigger problem, and it does create some longer-term issues for society as a whole. If students are dealing with higher levels of student loan debt, they may not be in as good of a position to purchase homes or to be able to afford certain big ticket purchases, which of course has the potential for additional negative economic impact, or reflecting other aspects with respect to what to do in terms of having families and other factors. In terms of the small business community, the latest with the small business community NFIB survey, overall small businesses have been pessimistic for the last year or so. A lot of that, of course, is driven by what's been going on in Washington and by some other challenges that small businesses have. It does look like optimism did improve. It improved in June by about 7/10 of a point, though overall it remains at 94. This is something that needs a measure of 100 is a reflection of positive optimism. And as you can see, some aspects in terms of increasing capital spending and expecting economic improvement in retail sales. There are some signs those are moving in the right direction, but some of them still are in a negative zone when you take the full look. The strongest one there is the plans to, of course, continue to invest money in their companies, as well as the fact that they are hiring. So those are two good signs. But again, the biggest challenge that small businesses have is uncertainty, and that does continue moving forward. And the quote there in the bottom right does kind of refer to that directly. So that was all for the materials that I had to share with you today. And I am looking forward to meeting back up with y'all on August the 11th at 1 p.m. Eastern. At that time, we'll have a good chance to kind of wrap everything up for 2016 in the first half of 2016. Have a little more in-depth information of some data that's not yet available yet for June, as well as maybe some early data for July. Take a real good look at GDP as of the end of the second quarter. Really try to get into the various components of GDP and see how each are performing, because they may provide more insight into the segment of the economy that you're working with directly. And then we are going to take a little bit deeper look at debt, because not only from the standpoint of private debt, but also public debt, and also may take a look at public sector revenues in terms of what revenues are being generated by governments and how they are doing with respect to their employee retirement systems. There are some states out there that have some serious challenges with respect to how to maintain adequate funding for their retirement systems, while at the same time understanding that money has to come from somewhere. So definitely a lot of good information that we're going to take a look at in a webinar on August the 11th. At this time, if anybody has any questions, I'll be happy to answer them. I'll go check over in the chat real quick. Don't see anything off the top, but if anybody did have any questions, I'll be happy to wait here just for a second. This session was recorded and will be available online through YouTube and through Facebook, hopefully sometime later today, or if not, first thing tomorrow morning. Really looking forward to making that available. I know a lot of people sometimes don't have the chance to necessarily tune in, so want to make sure that they have the ability to watch it later at their leisure. So seeing no questions from anybody, I'm going to go ahead and close it out. Thank you again for your time, and I greatly appreciate it. And one last thing I wanted to mention is I do try to make, my intention is not to charge for providing these webinars, but there are some costs going forward. I've been able to use some free trials of the meeting software, but at some point I have to start figuring out how to cover the cost for these. So if you're interested in if you're a business and you would like to potentially sponsor for a small contribution to make these presentations possible, certainly get in touch with me. I would be happy to talk with you. So seeing that there are no further questions, I'm going to go ahead and wrap up this presentation. Thank you very much for your time, and have a good rest of the day. It's hot out there here in the Carolinas, so be careful. I imagine it's hot in many places across the country, but be careful and have a wonderful day and enjoy your summer.